Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. Bitcoin birthday. The OG cryptocurrency becomes a teenager and hits a new hash rate. What caused the crypto market crash that followed? Solana stagnates. Developers cite degraded performance as questions arise around Solana's stability. Why this could be nothing more than FUD. Crypto holders of the world unite. Avalanche's first initial litigation offering goes live, opening the door to a new dimension of legal action. How does it work? Aave's emerging empire. After revealing an institutional DeFi platform, Aave hires Twitter's top data scientist to build its social media platform. Is this the beginning of the end for big tech? Samsung's crypto love. One of the world's largest electronics companies reveals an NFT platform, a virtual store in Decentraland, and partners with a Cardano project. Everything you need to know. Crypto tax coming for your ass. South Korea and Thailand announce plans to tax crypto as the IRS announces payment app tracking in the United States. Where can you go to protect your gains? UK crypto crackdown incoming. Crypto.com sees 2 ads banned while politicians debate a full-scale assault on the industry. What it could mean for your favorite crypto channel. And a closer look at what comes next in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last Monday marked 13 years since the first Bitcoin block was mined, and Bitcoin's hash rate, i.e. computing power, simultaneously hit an all-time high. The first Bitcoin block contained the headline from the Times newspaper for January 3rd, 2009, which read, quote, "Chancellor on brink of second bailout for banks." This hidden message was meant to underscore Bitcoin's role as an alternative to the current financial system, which is controlled almost exclusively by central banks around the world. The historical correlations between monetary policy and the price action of asset markets are as clear as day, and the recent crypto crash is no exception. The crash we've just witnessed was caused by the same thing that crashed the stock market and the precious metals market: the release of the minutes, i.e. summary, of the Federal Reserve's December meeting. The minutes revealed that some Federal Reserve officials seemed keen to increase interest rates at a faster rate than originally planned. As we all know, increases in interest rates have negative impacts on company investments and consumer spending, both of which impact on stock market valuations. And because asset markets are forward-looking, they are beginning to sell now, even though the actual interest rate increase is still months away. The good news is that it's likely the Federal Reserve will cease its aggressive interest rate rhetoric when the adjusted inflation figures come out for December, this Wednesday. The bad news is that Bitcoin is also experiencing a crypto-specific factor which is dragging down the price of BTC, and that's a massive drop in hash rate due to an internet outage in Kazakhstan amidst ongoing protests there. China's crypto crackdown from May last year suggests that this hash rate will eventually find its way to Western countries, primarily the United States. That was good news for crypto mining companies in the recipient regions, but bad news for Bitcoin, as most of its hash power may soon be coming from countries like Kazakhstan, which is becoming increasingly hostile to proof-of-work mining. This could put Bitcoin in danger in the not-so-distant future. Now, Bitcoin isn't the only cryptocurrency feeling the pressure these days either. Last week, Solana experienced not one but 2 episodes of, quote, degraded performance. While these issues were reportedly caused by another distributed denial of service, or DDoS attack, Solana founder and developer Anatoly Yakovenko explained that they were in fact due to an ongoing Solana upgrade. The same can't be said for the issues Solana experienced in September and December last year, however. These were in fact caused by DDoS attacks. Now, for those unfamiliar, DDoS attacks essentially involve spamming a service with too many requests so that it goes down. In this case, that means spamming a cryptocurrency blockchain with too many transactions so that it grinds to a halt. Some analysts believe that the insanely low transaction fees and predictable transaction ordering created by Solana's proof-of-history technology makes it more susceptible to DDoS attacks than other cryptocurrency blockchains. Assuming this is the case, it's something that can and likely will be fixed before Solana's actual mainnet launch. Solana, remember, is still technically in beta. What cannot be fixed, though, is the blockchain bloat that every Layer 1 cryptocurrency will experience. Now, in plain English, degraded performance is something almost every crypto will experience with enough users and transactions. Polygon's own degraded performance last week is proof of this. Polygon's poor performance was caused by a play-to-earn blockchain game called Sunflower Farmers, which CoinDesk says created conditions akin to, quote, an unintentional distributed denial of service attack. Even Ethereum's Arbitrum scaling solution saw an outage over the weekend due to high demand. Still, there's no question that Solana needs some serious work, and you can see how much progress the project has made by watching my most recent update about it using the link in the description. Anyways, another Ethereum competitor that made the headlines last week was Avalanche. This is because of the successful launch of the first ever initial litigation offering, or ILO, something that Avalanche had been planning since December 2020. As the name suggests, initial litigation offerings make it possible to crowdfund the money required for a lawsuit using cryptocurrency. In exchange, token holders for the ILO they participated in stand to gain a cut of the damages awarded by the courts, assuming the lawsuit is successful, of course. The first ILO features an American company called Apotheo, whose legal hemp farm was unlawfully destroyed by local law enforcement in its California county, or so it alleges. The value of the destroyed property is estimated to be worth up to $1 billion, and these are the damages that Apotheo is claiming. Now, fighting such a case against a state is going to cost a pretty penny, which is why Apotheo opted to go the ILO route, and it has raised over $300,000 so far. It's not entirely clear how much token holders for this ILO stand to gain if the lawsuit is won, but according to Cointelegraph, these ILO tokens will become tradable in roughly 3 months, at which point you'll likely see them on Avalanche dexes such as Trader Joe. The significance of Avalanche's ILOs cannot be understated, because money is often the barrier which prevents the average person from bringing the people in power to justice. Apotheo is just the tip of the iceberg in this regard, and Avalanche hopes to make it possible for regular people to participate in the litigation funding investment market, which currently tops $11 billion and is limited to accredited investors, as always. Now, if you're interested in getting your hands on some of these ILO tokens when they inevitably land on a DEX, be sure to check out the Avalanche tutorial using the link in the description. Speaking of DeFi, Aave has announced the official launch of Aave Arc, its institutional borrowing and lending protocol. Now, in contrast to the regular Aave protocol, Aave Arc is permissioned, meaning it requires KYC to use. This may not be appealing to the average crypto holder, but it's what institutions need to interact with DeFi. So far, over 30 institutions have signed up to use Aave Arc, the first being Fireblocks. For those who don't know, Fireblocks has become one of the world's largest cryptocurrency custodians, with tens of billions of dollars in assets under management. And this means that Aave Arc users will have access to some serious liquidity. As reported by multiple mainstream media and crypto media outlets, institutions are hungry for DeFi because lending and borrowing rates are determined by the free market rather than the central bank. It's not currently clear what effect Aave Arc could have on the price of the Aave token beyond speculative pumps associated with Aave Arc announcements. The fact that Aave Arc's creation was determined via governance suggests that institutions may begin buying Aave to have a say in how Aave Arc is changed, but this may be decided in a centralized manner. What is clear, however, is that Aave founder Stani Kolechov wasn't joking when he mentioned Aave would be building a, quote, Twitter on Ethereum. Over the weekend, Aave hired Twitter's top data scientists in the latest of many high-profile employee acquisitions. Other recent hires include a former team lead at Apple and a former business development specialist at TikTok. Now, despite these impressive moves, though, Aave's social media plans have hardly made the news. This could be because Aave's promise of a Twitter on Ethereum sounds too good to be true, but it's also possible that Aave's upcoming platform could become a viable competitor to its centralized equivalents. Consider for a moment that Aave has over $400 million in its community treasury and has consistently been on the cutting edge of DeFi. This makes Aave a force to be reckoned with, and I'll be doing a much-needed update about the project later this week, so be sure to stay tuned for that. In the meantime, you should check out my video about the power of decentralized autonomous organizations, or DAOs, using the link in the description. Anyhow, as some crypto projects are starting to expand into centralized territory, some centralized companies are starting to expand into decentralized territory. The one that's leading the charge seems to be Samsung, and it made some massive crypto announcements over the last week. On Monday, Samsung announced that its upcoming smart TVs will be compatible with NFTs. Specifically, viewers, or rather users, will be able to view, buy, and sell NFTs. Although Cointelegraph claims that it's unclear which cryptocurrencies Samsung will support, if you watch my video about Theta, you'll know that it has been a close crypto partner of Samsung for quite some time. In other words, it's very likely that Samsung TVs will support Theta NFTs, never mind the fact that it shipped smartphones with Theta integrations in the past. On Tuesday, Samsung's US subsidiary announced that it had partnered with a Cardano project called Veritree to plant 2 million trees in Madagascar to fight climate change. Each of these trees will, of course, be tokenized on the Cardano blockchain, and this partnership could mean that Samsung smart TVs may someday support Cardano NFTs. Samsung's final crypto act was on Friday, when it announced that it will be creating a digital store in Decentraland. Samsung's digital location will be called 837X, and it will be modeled after Samsung's iconic physical location in New York City. It's not entirely clear what exactly you'll be able to buy in Samsung's digital store besides NFTs, and it's also important to point out that this location will only be open for a limited time. If you want to learn more about Decentraland, I have a video that can help you do that, and it's down in the description. Meanwhile, in Samsung's home country of South Korea, the government has announced that it will begin taxing inherited and gifted crypto starting this year. As it stands, inherited and gifted assets are not taxed in most countries, though the sentiment around this tax exemption has been changing in many countries where it's still possible. The South Korean government also announced that it would be delaying its 20% tax on any crypto gains over $1,000 until 2023, which is certainly good news for Korean crypto holders. This figure isn't far off from the 15% tax on crypto gains being put in place by Thailand for this fiscal year, a rate which will apply regardless of the amount. What's crazy is that cryptocurrency exchanges will be exempt from these tax requirements, while cryptocurrency miners will be subject to them. What's even crazier is that the US government will begin tracking every transaction worth more than $600 on payment apps like PayPal and Venmo this year. To put things into context, the previous transaction reporting threshold was $20,000. Now, it's not currently clear whether this reporting requirement will apply to crypto apps as well, but what is clear is that the threshold for reporting crypto transactions in general will be $10,000 when the provisions of the infamous infrastructure bill go into effect in 2023. If you're wondering which countries are offering more favorable crypto tax conditions, you can check out my video about that using the link in the description. I'll also have a video on some of the best crypto tax tools coming very soon, so you'll want to keep your eye out for that. One country which is not particularly pro-crypto these days is the United Kingdom, whose regulators have been banning crypto ads left and right. Their latest target was Crypto.com, which is famous for its massive marketing campaign that so far includes a viral video featuring actor Matt Damon and the acquisition of the naming rights for the Staples Center in Los Angeles. According to the Advertising Standards Authority, it pulled 2 of Crypto.com's ads because they were, quote, misleading. The ASA basically argued that Crypto.com was promoting the purchase of crypto using credit cards and was giving the impression that users would earn a much higher interest on their staked assets than advertised. Crypto.com took the moral high ground by agreeing to meet the ASA halfway, and it's currently working on a new round of crypto ads, which I look forward to seeing here in London. Now, the reason why the ASA's actions are so relevant to the Coin Bureau is because we've previously run advertising campaigns of our own, notably on the Tube, aka the Metro, aka the Subway. The purpose of our advertising was to direct English folk to a crypto channel where they can learn the ins and outs of this emerging crypto niche with minimal hype and zero shilling. The prospect for future ads of this kind from our company has been put into question, to say the least, but rest assured we will climb that mountain if and when we encounter it. Now, it seems that this mountain will come sooner rather than later, given the recent anti-crypto rhetoric being spouted by certain UK politicians. Funnily enough, the bulk of their concerns relate to the fan tokens of football clubs, which have of course been very popular in this country where football is close to a religion. Luckily, a group of pro-crypto lawmakers has come together to tackle the threat of outdated thinking head-on, and we will hopefully see some reasonable crypto regulations emerge in the coming months for the UK. Turning to the crypto market, we can see that BTC is holding on for dear life around the 40k range after coming out of a bearish pattern which broke to the downside on the daily. As I mentioned in yesterday's weekly newsletter, the Bollinger Band and RSI indicators on BTC's weekly chart suggest that this is a perfect time to buy the dip, though we could potentially head lower for one more week. The Crypto Fear and Greed Index likewise confirmed that there is a lot of blood in the streets, which is the perfect time to buy, according to Warren Buffett. Now, I will just reiterate that the worst may not be behind us just yet, and the record levels of leverage we're seeing in the crypto market isn't helping with all this short-term volatility either. Seriously, guys, knock it off. You know who you are. This week's winners are Internet Computer, Chainlink, Harmony, Dash, and Unis said Leo. Let me just say that I'm happy we have some winners out there at all this week. So, starting with the Internet Computer, it's clear to see that ICP has performed poorly since it began trading last May and is more than 10x below its all-time high, which was set around that time. ICP's short-term pump seems to be due to the recent release of District, a decentralized social media app built on the Internet Computer. District would be amazing were it not for the fact that using it requires creating a seriously dystopian digital identity which exists on a blockchain powered by hardware provided by the Dfinity Foundation, which created the Internet Computer. More about that in the description. ICP's price action suggests it could continue to rally to the $50 mark in the coming weeks, but I wouldn't count on it given all the ICP that the project's early investors are selling. Next up is Chainlink, and I couldn't identify a specific factor which caused Link's price to pump. My best guess is the abnormally high demand for Chainlink's data feeds during the crypto market crash that happened last week. Hundreds of millions of dollars of collateralized positions in DeFi protocols were liquidated, and there were likely a lot of arbitrage opportunities on DEXs as well. It looks like Link could continue to pump, but this all depends on whether it can break the strong price resistance at the $28 mark. If it does, the next stop for Link is likely $30, where there's no shortage of psychological resistance. As for Harmony, its OneCoin seems to be rallying on the news that 23 DAOs have been successfully spun up as part of its 100 DAO initiative. Harmony is also expected to release a trustless bridge to Bitcoin and Ethereum in the coming weeks, though it already has bridges to these blockchains via other crypto projects. As you can see, the OneCoin has a tendency to rally, and it's fast approaching its previous all-time high of 38 cents. If my technical analysis is correct, One is painting a massive cup and handle pattern on the daily, which could bring it back up to its previous all-time high and possibly up to 40 cents in the coming weeks. When it comes to Dash, its pump seems to have been caused by a combination of factors, including the upcoming release of a MasterCard program, which will apparently allow users to spend their Dash coins at merchants without KYC. Thorchain is also in the process of adding support for Dash to its cross-chain DEX, which will make it possible to trade Dash for other popular cryptocurrencies without KYC. Unfortunately, Dash is a very long way away from its previous all-time high and has had a long and difficult journey to its most recent high. And lastly, we have Unus Leo, which is Bitfinex's exchange token, and I reckon that's all that needs to be said there. If you want to learn more about exchange tokens in general, I have a video about that which you can find in the description. And that's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, and Instagram to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, folks, and I'll see you all in next week's episode.